I have a unique relationship with inflation. I have lived for years in an inflationary economy. I have watched for decades as friends and family who I love, who still live in that economy, have watched their retirement nest eggs get cracked, scrambled, and eaten by inflation. And I look at the US and realize that the financial underpinnings that we all rely on for retirement planning are broken when it comes to inflation specifically. We're not prepared for it. We don't think it's as big as a risk as it is. No one's talking about it. And the solutions that they do have when they talk about it are kind of crap. I forgot to introduce myself. My name is Jeremy Watson. Over the past 25 years, I've started 30 companies. Currently, I am running 7. I've spent 10 years adjacent to financial advice. In that time, I was consulting full-time on about $300 million. I'm going to share as much good knowledge as I can for free, hopefully to do some good in the world while sharing some interesting stuff. If that interests you, follow along. I appreciate you watching. One of my major gripes with financial advice while I was in that field for 10 years is I didn't feel like what's called modern portfolio theory, what's standard in financial advice, that it wasn't addressing inflation hardly at all. Like in all the classes I took, and all the continuing education I took, and all the professionals I spoke to, they act like inflation just isn't an issue. That's because inflation hasn't been an issue in the US since the 70s. It's been 40 years of non-inflationary times. If you look back at the 70s, some old timers, they have concern about it, but they seem to be like, okay, we've figured that out, we've licked that. And I just don't think that's the case. I do not think it's the case that we've got inflation figured out. I think that we have a ton of US monetary policy and global monetary policy that has insulated us from inflation. Like just being the world's reserve currency alone has insulated us from inflation. And a ton of our global and US monetary policy have just kicked the can down the road and made it possibly infinitely worse. And my biggest problem is, I think it is a much bigger problem than people know, and I don't think modern portfolio theory addresses it. I don't think current financial advice in the paradigm in the US of A addresses inflation. I just don't. The only way that they say it addresses inflation is that if there's inflation, stock values will go up. And that is true. Stock values will go up. But in retirement planning, you're talking about people who are in retirement and who are moving gradually their portfolio more and more of a percentage into bonds. And inflation's destroyed bond values in a way that is hard to describe. So I just don't think that modern portfolio theory addresses inflation in the US of A in a way that I'm at all comfortable with. What has developed in its place instead of a comprehensive solution for inflation and what asset classes do well is people who are really concerned about inflation have just gone to gold. 100%. Hey, if you're interested in this, buy gold. If you're interested in this, buy gold. If you're interested in this, buy gold. Today, gold's like at $5,000. It's gone through the roof after the Trump tariffs, which is a whole different thing that we'll have to talk about. But the bottom line is the solution for inflation in the USA has become just buy gold. And that's a really bad retirement plan. It's bad on its own level because it produces no income. Any retirement asset that you have, you should not have to sell the asset completely. You would hopefully have some stocks with some dividends or some real estate with some rent. You would hope to not have to eat the nest egg to survive one more day, right? You'd hope people draw down on it, right? Inflation can destroy any income producing asset in the US. It can destroy any of them. It destroys Social Security, it destroys pensions, it destroys fixed income annuities. None of them adjust well. I joined Imran Andrew over at 3-Dimensional Wealth for an hour-long webinar where I tried to present this theory. And my problem with this is no one's talking about this. No one is talking about this. It feels like it came from my own head and no one is talking about it. That's because I have a unique relationship with inflation. I have lived for years in an inflationary economy. I have watched for decades as friends and family who I love, who still live in that economy, have watched their retirement nest eggs get cracked, scrambled, and eaten by inflation. And I look at the US and realize that the financial underpinnings that we all rely on for retirement planning are broken when it comes to inflation specifically. We're not prepared for it. We don't think it's as big as a risk as it is. No one's talking about it. And the solutions that they do have when they talk about it are kind of crap. I don't think that US financial advice addresses inflation at all or well. And beyond that, I don't think that their financial incentives are in a position where they're interested in having this conversation. Join me for an hour-long conversation where we try to walk through the specifics of why I don't think it's addressed well and how we would solve it at Bedrock. I really do think that rental real estate over time, specifically 30-year fixed mortgage rental real estate, is a million times better to gold when it comes to retirement planning for inflation. I think it needs to be part of everyone's portfolio. I think this needs to be shouted from the rooftops. And unfortunately, unless you're Bedrock or unless you're a company who's designed a real estate-based solution, they don't have a solution, so they don't sell it. Hope you enjoy.
Without further ado, I'd like to welcome our guest speaker in today, the president and founder of Bedrock Investment Property, Jeremy Watson. I've known Jeremy for, Jeremy, we're approaching 15 years. And so excited to be able to have him on.
All right. Well, thank you very much, Imran. I appreciate that. I actually had a large chunk of my career working directly with Imran and their team. I was at the predecessor to Three Dimensional Wealth from 2011, late 2011 through 2018. The whole time I was working with them, I was always interested in the real estate that was coming across my desk. I would say in that time, I probably looked at and consulted on, gave advice on about $300 million. I would say probably 70% of that was trapped in underperforming real estate. So we've had a lot of these conversations where we talk about underperforming real estate and getting your underperforming real estate into properly performing real estate. But today I wanted to focus on inflation. I've experienced it more than the typical American. However, it feels like America's kind of waking up after 2 or 3 decades of no inflation to realize it can be a problem. People are looking around for the first time since the 70s and saying, hey, inflation can actually come on really, really fast, can affect me very, very deeply, can change my net spendable income, what I can afford, and my whole retirement plan if I'm not prepared for inflation. Now, the main way people prepare for inflation or traditional wisdom has been just buy gold. And the truth is, I think gold is a perfectly good inflation. If you buy gold, it'll be worth what you paid for it in 20, 30, 40 years. Gold never pays you a dime in the interim, right? As far as a retirement asset, as far as an asset that pays you money that you can spend on golf green fees, eggs or milk or gasoline, as far as something that actually pays money as you go, gold's a terrible retirement asset. Rental real estate is an incredible inflation protection and retirement asset side by side. Rental real estate just stomps all over gold in every metric that really matters. Rental real estate just stomps all over gold when it comes to actually hedging against inflation while still having a retirement asset that you can use instead of just having a box of gold under your bed. So that's my goal today. The reason I have a strong opinion about inflation is that it will probably have a larger effect on your retirement than any other single issue. Medical costs, which are tied directly to inflation. I can't think of something that will have a more direct impact on people's retirement and how much net spendable income they have than inflation. It affects every single expense category: healthcare, long-term care, food, housing. Every underlying expense in your life is directly affected by inflation. Now, the reason that I'm passionate about this is because I was lucky enough to spend from 2001 to 2003 on a church mission in a place called Maracaibo, Venezuela. When I got to Venezuela, the bolivar, their currency, was trading for about 800 bolivars per dollar. I was a 19-year-old kid. It was my first time spending another currency. I remember their currency looked totally different than mine, but more than that, I was spending 1,000 bolivar notes. The first couple of days, it took me by surprise because I was just like, wow, I'm spending these $1,000 bills. not realizing it works differently in other countries. I would buy almost every single day what they call pan francais, which is French bread, these little breads. That was one of the things in Venezuela my stomach could handle. So I bought pan francais every day for a year, spending 1,000 Bolivar note while I was in Venezuela. Hugo Chavez had just been elected. If you follow Venezuela, it saw a spike in inflation from 2001 to 2003. When I got there, the Bolivar was trading at about 800 to the dollar. When I left, it was about 3,800 to the dollar. The value of the Bolivar had dropped by about 66%. There was a black market for dollars, and the government was suppressing the actual Bolivar value. When I left that same French bread, I was spending a 5,000 Bolivar note. I was spending 1,000 Bolivar note. Inflation hurts everyone. Inflation hurts the working man. It cripples retirees because everyone goes about their lives. We've seen inflation from 2017 to 2025 in people's adult lives, or certainly in the amount of adult life that people remember. What we've all seen is that it hurts really bad in the beginning, and then all the prices kind of tick up to follow it. Eventually, salaries are adjusted upwards. What doesn't adjust upwards are fixed income products. Different pieces of the economy adjust differently. For example, here's a chart from back to 1998, the different things that have inflated in price. What you can see is hospital medical has gone through the roof. Medical care services have gone through the roof. Food and beverage have gone up substantially. And then the things that you really don't buy every day, like TVs, are a lot cheaper than they used to be. I don't buy a TV every day. I don't buy a cell phone every day. I don't buy a new car every day. The things that really have inflated with price are really those things that we buy a lot. And even more than that, they're the things that affect retirees, specifically health care, retirement care, assisted living care. All of those are going up far faster than inflation. That can affect retirees more. Hey, my money's worth less, and the things that I'm buying are actually outpacing inflation very substantially. And so it injures working people. Everyone feels inflation. It really cripples if they're already in retirement. Pensions, Social Security, lifetime income annuities, all adjust based on the CPI, or the Consumer Price Index. This is not going to be a conversation on the Consumer Price Index. I'm going to give you guys just a 1,000-foot view, but there are so many problems with the Consumer Price Index, and that being the way that we're all saying my Social Security will adjust based on a cost of living adjustment based on the CPI. My pension will adjust based on cost of living based on the CPI. Every annuity ever sold on the planet will adjust by cost of living adjustments based on the CPI. But there are at least 100 different ways different countries have found to factor their cost of living adjustment. The way the CPI effectively works is the government runs what they call a market basket of goods. And they weight in 8 major categories the different things that cost different amounts. As time goes by, they take things out of the market basket of goods and they put other things into the market basket of goods. For example, they took out corded house phones and put in cell phones. They took out typewriters and put in word processors. They took out word processors and put in home computers. So that market basket changes. Number 2, the government decides what goes in and comes out. Number 3, the most expensive things that have inflated the most aren't necessarily weighted the most. For example, medical care has gone through the roof. Education has gone through the roof. Food and beverage has gone up substantially, but those are some of the least weighted pieces of the CPI, where they're weighting a lot more. Housing, which has also gone up a lot, and apparel, which has gone down. The CPI, number 1, it's a market basket of goods that the government sets and adjusts. Crucial part to understand, Social Security, pensions, annuities have cost of living adjustments based on the CPI. 3 fundamental problems with inflation. Number 1, the government has a vested interest in understating inflation. Number 2, the CPI can be very inaccurate. Number 3, most of the things that go down in price you don't buy frequently, where most of the things that go up in price you buy every day are factored into the CPI. Inflation, even though the CPI may say 2%, what we're actually feeling may be worse. The government has a conflict of interest in understating inflation. It makes them look incompetent, out of control. It makes them look like they don't have control over the economy. We have seen that from 2017 to 2025. The government kept saying, oh, inflation, things really got expensive. Housing went up by 30, 35%. It took really aggressive interest rate policies, kind of jacking all interest rates up by 2, 3, 4%, and leaving it there until the economy almost stalled into recession 2 or 3 times. Now they've had to back off that key interest rate 4 or 5 times. They may back off, they may not back off, because they're just dancing this, hey, we have to keep the interest rate high to curb inflation. But that's created problems. It's locked people into the housing market. It's locked people into, their old 3.5% interest rates, where, organically, if interest rates were comfortable, housing would be buying and selling as typical. So number one, it makes them look out of control. Number two, it fundamentally increases their financial obligations, because Social Security is tied to cost of living adjustments, which are tied to the CPI. Increases interest payments on debt, because they're having to refinance 10-year treasuries, 5-year treasuries, 1-year treasuries at current market interest rates. If market interest rates go up by 1 or 2 or 3%, the national debt refinancing that's coming up on short-term T-bills, those are going to be getting refinanced at higher rates. And so their debt maintenance goes up. Their financial obligations go up. And they look like idiots. If any of us were in charge of the government, none of us would like these 3 things. The economy is getting rougher, everything's more expensive for everyone, while at the same time, my financial obligations, I'm having to pay more in Social Security, I'm having to pay maybe more in Medicaid, I'm having to pay more in Medicare, and I'm having to refinance all this debt that the U.S. carries at higher rates. So the government has a lot of reason to try and damp down talks about runaway inflation. In Venezuela, the government never admitted the entire time I was there that their inflation was rampant, right? And their value of their currency while I was there, just in that short period of time, dropped by like 66%. I don't want to spend a ton of time talking about this conflict of interest. I just want to draw your attention to it. If you look online, if you watch anything on inflation, you will see a federal CPI number reported. Economists have questions about that, right? Is it much higher than reported? Because it could affect the poor and seniors. There's tons of articles and videos where people talk about this. The government has a vested interest, I would say a conflict of interest, when it comes to understating inflation, because it affects them very directly, and they're the ones who control effectively what goes into the CPI, what comes out of the CPI, how the CPI is calculated, and when the CPI is calculated, and when measurements are taken. For example, here are fact sheets for cost of living adjustments for Social Security. I pulled these straight off socialsecurity.gov, and you can see in 2025, they're saying, hey, our cost of living adjustments 2.5%. Okay. It didn't feel like things only got 2.5% more expensive last year. In 2024, they said cost of living is going to be 3.2%. In 2023, they said 8.7%. And if you recall, 2022 to 23 is when real estate went through the roof. Real estate prices in our portfolio, because Bedrock helps investors buy property. We're buying and selling property all over the country. We saw real estate property values go up between 20 to 60%, depending on the market. Cost of living adjustment of an 8.7% in the most inflationary year we've seen in modern history did not feel even remotely close to how expensive things got on a day-to-day basis. Milk doubled in price. Eggs quadrupled in price, 400%, not 8.7%. Social Security in each of these years. And I just went and pulled it down, 5.9% in 2022, 1.3% in 2021, 1.6% in 2020. We saw real-life inflation really kicking the crap out of net spendable income. You can look back. 2%, 0%, 0%, 1%, 2%, 3%. They only adjust Social Security a bit at a time. And if minimum Social Security payment's $1,900-ish a month, then a 1% increase is another $19 a month. $19 a month isn't going to affect anything for a year. right? And so my number one problem with this is government may have a vested interest. They have a direct conflict of interest when it comes to COLA, when it comes to the CPI calculations year over year. Even in the worst inflationary period the US has ever seen, they do not want to admit that because it makes them look incompetent and it makes their financial obligations worse. It makes their balance sheet look worse. The CPI itself is riddled with inaccuracies and biases, which everyone admits, but we've decided to calculate it this way. The CPI has limitations. You can read up on that from the St. Louis Fed to Wikipedia. They all seem to agree there's some inaccuracies. And there are like 10, 15 major inaccuracies with the CPI. I'm only going to focus on 2 or 3. Number one, the substitution bias. The CPI maintains a market basket of goods. That market basket of goods is changed. The CPI may say, hey, steak costs $25 for this much steak. But what the CPI does not do is if steak gets too expensive, the CPI does not swap that out for customers saying, hey, steak is too expensive for me now. I'm going to eat more hamburger, more chicken, less meat. What's called a substitution bias. The CPI does not factor in that people's buying patterns are actually buying less expensive stuff because it has a specific market basket item. We're just going to say steak is $25. People's net spendable income or quality of life may be adjusting downwards. Even in my own life, I've got a wife and 4 kids. We don't eat steak as often because now a 4-pack of steak at Costco is $75, where 5 years ago a 4-pack of steak at Costco was $35, $40, right? Like the price for steak in my family, and I've got a kid who loves steak. We just don't eat it as much anymore because we'd rather spend our money different ways. So substitution bias doesn't even come close to accounting for buying habits because the market basket of goods is fixed. Number 2, geographical coverage. The CPI is a national average, and if you've ever lived in San Diego, LA, New York, or Portland, you know the national average does not represent your reality. Things can get much more expensive, specifically on the California coast. Even Utah is much more expensive than the national average. They don't factor that in at all. The CPI uses what is called owner's equivalent rent to calculate housing prices. And what that means is how much would you pay to rent the house you currently own instead of how much would it cost you to buy the house? Since rent prices can be dramatically less in some markets than buying houses, we buy houses all the time. Our team's helping buy over 4,000, 5,000 homes. Equivalent rent understates how much it costs to actually buy and own a home, which most people want to be doing in retirement. And number 4, healthcare costs. The way the CPI calculates healthcare costs is by measuring out-of-pocket expenses instead of actual costs paid through insurance and HMOs. And so the bottom line is out-of-pocket expenses, especially for people on Medicare and Medicaid, are dramatically understated because Medicare and Medicaid have much, much lower out-of-pocket expenses than do insurance coverages. And they're not even talking about insurance coverage. They're just talking about what people are paying out of their pockets. So we're talking co-pays and prescriptions after benefit cards or after deductions, but that is massively understated. That one these two just feel like they are trying to keep it low by artificially flattening out what people are actually seeing in their lives. But the CPI has at least 10 major problems documented by almost every economist, and that is the indicator used to adjust Social Security, annuities, pensions. Anything fixed income is being adjusted by the CPI, and I think the CPI is understating people's cost of living increases substantially. The things people buy most often are going up in price. How do they say the highest inflationary year in the last 2 decades was 8.7%? How do they get to that number? It's the average of the market basket, right? So they're saying all these things get away with all the ones that went up and down, things were 8.7% more expensive. If you're in a hospital with medical issues, which retirees very frequently have to deal with, or if you've got long-term care or a kid going to college, some of the things that move up the fastest directly affect retirees more. And again, People aren't buying new televisions every day. Who cares if it's getting less expensive? It's dragging the average down. People aren't buying new cell phones every day. It's dragging the average down. People aren't buying new cars every day. There are things we just don't buy every day. You buy once and then you don't buy again. If they inflate too much, you might just wait to get a new car. You might just wait to trade in your cell phone. But food, hourly wages, hospital services, long-term care, those things are going up. By taking this average, it can understate actual living expenses, how much you have in your pocket, how much life you're able to afford, because the things that are included in that market basket are going down and dragging the average down. You don't buy every day. Most retirees who are set aren't buying those things at all or very infrequently. Inflation hurts the working man. He can keep working. He can wait until his salary adjusts. He can maybe, it's a two-income household, maybe both of them work a little more. Once you're in retirement, drawing down from your 401k, your mutual funds, your bonds, if your actual underlying currency devalues, which is inflation, and doesn't go as far, that can really, really hurt you. I know a Venezuelan. I know him personally. I love this guy. When I arrived in Venezuela, he had a lifetime pension from PDVSA Petroleum, and he was earning $150,000 a year equivalent. He had a beautiful house, car, wife, worked for PDVSA, had a pension, retired, lovely human, right? In the time I was in Venezuela, his guaranteed lifetime pension went from being about $150,000 of purchasing power, went down by 66%. When I left, he had $50,000 of purchasing power. It made a mess in 3 years. Unfortunately, that was not the whole story. When you study inflation and economies whose currencies have inflated, you'll see a lot of charts like this. This chart is saying how long does it take for your money to lose 99% of its value? Venezuela lost 99% of the value of the money from 2010 through 2012. And then they lost 99% of their value again during this set of brackets, right? These brackets are all lost 99% of their value. They lost 99% of their value again from 2012 to 2016. And then they lost it again and again because Venezuela got into a cycle of printing more money, which led to more inflation. They got into a cycle of more borrowing, which led to more inflation. A key economic indicator in Venezuela, the price of oil, went into the ground. They borrowed more money, printed more money, experienced hyperinflation. They are in a horrific situation where their money is practically useless. It has been gut-wrenching to watch because I love some people in Venezuela. That gentleman I talked about while I was in Venezuela went from $150,000 of income. After 2012, his income was probably worth $1,500 because it had lost 99% of its value. And then that number just went down and down. That $150,000 a year pension, again, it's not adjusting well for COLA, cost of living, because the government has never admitted, hey, this is all going terribly wrong. That $150,000 pension, when I got to Venezuela, is now worth some hilariously tiny fraction of a penny. It's been heartbreaking to watch. Now, the immediate response would be, but Jeremy, we are not in Venezuela. The dollar is much stronger than the bolivar, and we're not at risk of that. My sentiment to that would be, we have experienced a 96% drop in the valuation of the dollar already. From 1913 to 2017, the dollar has lost 96% of its value. Anyone alive from the 30s on can testify to that very directly. The US dollar has lost value over time. The dollar has lost almost 42% of its value over the last 20 years. We experience inflation that erodes buying power. Everything gets more expensive. Remember, 20 years ago, a new car was $20,000, $25,000. Now a new car is $45,000 to $65,000. It just slowly erodes. It's the frog in the pot of water, right? And so that is what is really important to understand. Like, it's happening behind the scenes, but people aren't preparing their retirement assets for it. Think of your retirement asset right now. Just take 4 seconds and think, what assets in my portfolio are specifically to adjust for inflation if it occurs? When I've had a conversation with my financial advisor, what steps are we taking to adjust for inflation. We've had inflation in the last 6 years. How have my assets held up to everything being more expensive to the tune of 20 to 60%? Have my stocks gone up by 20 to 60%? Or has my real estate gone up by 20 to 60%? Have my bonds gone up 20 to 60%? Or have my bonds gone down in face value because I've experienced higher interest rates and so the face value of my bonds is actually depleted? There's a lot of assets that are the financial underpinnings of the US that do terribly in inflationary times. But because the US has not experienced inflation until 2017 in my life, people, I think, are asleep at the switch, realizing that they have to make sure their retirement assets can handle inflation, especially if they're counting in any degree on fixed income pensions, fixed income annuities, or fixed income Social Security. Because those things specifically, because they adjust with the CPI, have weaknesses that inflation can just scramble the entire thing in a hurry. Unfortunately, I may be understating this. I'm sorry to say this, but reserve currency status has kept inflation at bay in the US. In the last 10 years, countries like Russia and China have agreed to settle trade in their own currencies, not using the US dollar as a reserve currency anymore. The BRICS countries have basically agreed to the same thing, trying to find a reserve currency that they can all use in place of the US reserve currency. Our US debt globally is hilariously high. If it goes bad in a couple of ways, we could see inflation come home in a way we've never seen in our lifetimes. If that's the case, we should understand our retirement assets need to be able to handle that in some way. Real estate, in my opinion, is that solution. I don't think there's another great solution out there when it comes to inflation. Gold is great if you can put it under the bed. The problem is it doesn't pay you as you go along. Real estate, it comes down to two fundamental relationships. And I'm going to try to graph these out for you. And I'm going to try to help you understand. I have done at least 30 hours of research preparing for this webinar, where I've read articles, looked up stuff, watched people talking about this, watched economists, and I lived inflation when I was young. And I've experienced it in a way that most Americans have not. I have not been able to find almost any good visuals to illustrate these points. I've had to create them myself because no other financial services firm is publishing anything on this topic. Let's go through it together and see why real estate works so well as an inflation hedge and a retirement asset in inflationary times. It comes down to two relationships. Number one, your mortgage balance versus your property value. How much I owe versus how much it's worth. And how much I pay to hold on to the asset versus how much does someone else have to pay to live in the asset, right? Those two relationships really matter when it comes down to why would I maybe consider having a piece of real estate to help with inflation. If inflation's coming, why consider buying? Real estate goes up with inflation. The value of your property is going to go up with inflation. We're going to look at a couple charts and show that. Rent goes up with inflation. If you sell it, and it's effectively only worth what the dollar would have been worth had you held it in gold. It keeps up with inflation, but it does not pay you the whole time. Real estate pays you the whole time while the asset goes up, while the cash flow goes up. That's what we really want from a retirement asset. We don't just want something that's going to sit there under our bed and only be worth what we paid for it in 15, 20 years. That's what gold does. We want something that's going to pay us the whole time and keep up with inflation and maybe even do us a little bit better. Number one, the mortgage balance versus the property value. I just pulled this one from Colorado. You want to buy in any market, right? No matter where you buy any piece of real estate, if you see inflationary times, those values will go up. Now, some real estate's going to go up hotter than other real estate, but we just want to be on the correct side of this bet. We want to buy, understanding it is an asset, and that as inflation hits, the asset value will go up. Same as gold. As we see inflation, gold is worth more. As you see inflation, real estate is worth more. Just look at any piece of real estate you have ever bought in your life, and you will be like, yes, he's right. Real estate does go up kind of based on inflation. He's right. It goes up based on inflation. So in that one regard, it is very similar to gold. Here's the fundamental difference. If you buy this little house, and I know these are slightly different houses, but there's meant to be average home buying in the US. If you buy this house for $39,000 and your mortgage is $35,000, in 20, 30 years, your mortgage will have gone down to like $15,000. In 2014, that same asset's worth $450,000. So my mortgage is still only 15, but the asset has gone through the roof. That same average house will have a mortgage payment where we bought it at $346,000. Now that same average house is renting for about $2,600. So my rent went up. My mortgage stayed the same. My value went up. My debt went down. Inflation helped this person in every regard. If I had bought this house in 1970 and it had a mortgage of $346 and my rent had gone up and now it's at $2,600, right? That means that as everything got more expensive, I would have had more cash flow to deal with that. If I had spent $35,000 back in 1970 and slowly been paying off my mortgage and now I only own $15,000, but the value of my asset went up to $470,000, I am much richer on paper. My assets are worth effectively the same once I adjust for inflation. The difference is gold doesn't allow me to do this. Gold does not allow me to buy at 80-20 leverage. The bank is not going to lend me 80% of the money to buy gold. I'm going to have to put $100 dollars into my gold. I'm not going to be able to lock into a 30-year fixed mortgage to buy my gold. And instead of buying gold, I could have a fixed locked-in mortgage payment while rents do increase over time with inflation. I have more net spendable income. Every time inflation rears its ugly head, I get a raise, right? Every time inflation rears its ugly head, I owe slightly less because the time's going by, but on my balance sheet, I'm worth more. Real estate, you are helped with inflation, not hurt, and you can pay your bills over time because it's paying you all along instead of gold where it isn't, right? Here's an example. If I bought in 1977, because there's no one in the industry having this conversation I could even find, right? If I bought this house at 1977 for $45,000, my mortgage balance would have gone down over time, where the value of average homes in the US went up, 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 big dip after 2008, up, up. The value of the home went up, the value went up. There was even a huge dip. There's a relationship between, that's the blue line, right? And what our mortgage balance is, that's this bottom red line. Your mortgage is getting paid off over time. You owe less money on your balance sheet, where the asset is inflating away. And look at that top orange line. That top orange line represents inflation adjusted prices. Less crazy than the blue line, because effectively the property is adjusting for inflation. It's worth a little bit more than you bought it for. But that trend line is so much less than the blue line. When there's more money in the economy, people pay more for houses. If we bought that property in 87, you would have paid that same property off by 2017. Your mortgage balance goes down over time, where the value of the property goes up over time. On my balance sheet, I owe less. My property's worth more. That's exactly where we want to be as far as an inflation asset. What if I bought my property in 2017? Some people might be saying, well, I'm too late to the party. Number one, I don't have good math for that. We would still be barely paying off that mortgage. Property has gone up substantially since 2017. Property goes up over time if there is inflationary pressure. It is an asset, and that asset goes up over time. Your debt goes down, your asset value goes up. The second major relationship that matters is the mortgage payment versus the market rent. And this can get confusing. So here's what I want you all to see. This is a chart that shows the average cost to buy a mortgage and the average cost to rent. What you can see on this chart is that over time, both have gone up. But you want to buy when your mortgage locks in on $225 a month and your mortgage stays the same for the next 30 years because your mortgage payment is on a 30-year fixed interest rate. It's never going to change. Your payment's going to be $400 a month for 30 years while rent goes up. All right. So we want to be in a position where we're paying $260 a month for our note, but the rent is now up to $1,800 a year, because that creates a substantial cost of living increase that's directly keeping up with inflation. If inflation goes up, rent will cost more. We renegotiate. Rent payments have gone up substantially since 2017, not because every landlord is greedy, but because landlords' fixed expenses have gone up. Eggs have gone up. Gas has gone up. Homeowners insurance has gone up. There have been upticks in expenses, and that rent has gone up to compensate for that. They have as much money as ever. The beautiful thing about being a landlord with a 30-year fixed mortgage is the mortgage has not gone up. The debt maintenance has stayed the same. And so that's the magic of it. Get a fixed interest payment on your property and let rent go up over time. If you bought a house in 1960 for $11,000, now it's worth $380,000. The average cost of the home in the U.S. The average rent / mortgage in 1960 would have about $70. Now it's about $2,000. The asset's going up over time. Rent's going up. Mortgage getting less because you're paying it off. Mortgage payment staying the same. The 30-year fixed mortgage may be the ultimate tool to fight against inflation. The fact that there is such a thing as a 30-year fixed mortgage is baffling to me, because I do not believe it represents the amount of risk that banks are taking. And if you want to do some research, I'll give you this mental exercise. Imagine you are working and you're saving. Like the average well-to-do American may be able to put away $20,000 a year if they're saving, maybe $50,000 a year, maybe $70,000 a year. I'm going to say $50,000 a year. How much can you really save in a year after all the expenses and all the taxes and raising your family, paying your mortgage, right? How much can you really save a year? 50 grand, right? That's a good saving year. How much would I have to pay you to borrow $500,000 to buy a house? How much would I have to pay you for 10 years of your hard-earned savings, assuming you are really saving, putting it all on the line? How much would I have to pay you in interest to borrow $500,000 to buy a house? I would bet money it's more than 6.8%. It is absolutely more than 3.65%, which we were at for almost a decade and a half, right? This rate was artificially low because the government was printing money and suppressing that rate. This rate is still artificially low, and that's why when you look back at the 70s and the 80s, you'll see the interest rates were 14, 15, 16%, because the government had not rolled out Fannie Mae, Freddie Mac yet. The government had not started artificially lowering interest rate yet. The government had not established a secondary market where mortgage-backed securities were being sold yet. And by doing that, they were able to drive down interest rates on 30-year fixed mortgages artificially low since the 80s. The important thing to understand is that those rates are still low. The fact that a 30-year fixed mortgage even exists is incredible. It's like the ultimate tool for financial wealth and to fight inflation. People ask, but what happens if rates go back down? Rates are high right now. I hear that all day, every day. Bedrock helps people buy real estate. And the bottom line is we deal with interest rates all day, every day. So there's only three things that can happen if interest rates change. They can go up. What if they go higher? Let's say I borrow at 6.8 right now to buy investment property. What if they go higher, right? Well, then I will be grateful that I got at 6.8. You know, if interest rates go to 15%, I'll be grateful I've got at 6.8. Note, if interest rates go to 30%, I will be grateful that I'm locked in at 6.8. If they go higher, I will be happy. What if interest rates go lower? Well, if interest rates drop to 3.5%, I'll refinance it. I'll pay the fee and get a new lower rate. The other thing that can happen is they just stay at 6.8 forever. I'll be pretty happy I bought a piece of real estate at 6.8. They can go up, they can go down, they can stay the same. I would rather buy a good cash flowing asset today, ride the inflation wave and let it go up in value, let my rents go up, than stay on the sides of the market because I'm waiting for interest rates to go down. Again, because they are not that high. They are artificially low because of the way the government subsidizes mortgages. So with that being the case, I've always loved real estate. Okay. Over a decade in financial advice, consulting on almost $300 million, I saw 20, 30% of people's portfolios was in their 401ks, stocks, or bonds. The majority of the wealth I saw was in real estate. 60-70% easily consulting on financial advice. And these were the only assets people were talking about because their real estate was locked in Northern California in hideous places that they didn't want to sell because of tax murderings, or they had made their money in real estate, but they didn't feel comfortable changing it because they were used to their tenants. Their assets were in their backyard. They were comfortable with it. What I saw was if we could fix the real estate piece of people's portfolios, then we would really be cooking with gas. And so I left working with Imran and the team after 12 years. I founded Bedrock. We've been helping people buy and manage properties. One of my financial advice clients bought this house. It's in Detroit, Michigan. Okay. And that house he bought for $53,000 from a big turnkey house group. They said, hey, you can buy this house for $53,000. It rents for $900 a month. What we call a GRM of 53. Now, I shop for GRMs less than 150. That's very important. If I could get GRMs at 53, I would be inducted directly into the Real Estate Hall of Fame. Okay, we haven't seen prices like that since 2009, 10, and 11. He was buying a terrible asset in a depreciated market. Unfortunately, he had to replace the tenant 3 times in a year. Each time you replace the tenant costs about $4,200 to get the tenant out of the property to do repairs on the property. Luckily for this client, it burned down and the insurance paid him $88,000 to rebuild. That client had no desire to buy another through the turnkey house. He was like, I'm not doing that again because I've been flying to Detroit for months. The question, if you're going to buy real estate, is will it go up in value? Will I have a competitive cash-on-cash return? And how much time is it going to take me to manage? Those are the 3 fundamental questions in everyone's mind right now. I think real estate may be a decent place that I need to be putting my retirement assets. But my question is, what's my cash on cash going to be? Is the asset going to go up in value? How much time will it take to manage? The biggest weakness I saw while advising on assets was that the companies selling real estate had no vested interest in the success of the asset. They sell you a house. If it sucks, you've got a grenade in your portfolio that you get to deal with. There needs to be some fundamental changes to turnkey. You need to be able to buy with a company, vetting it as if they're going to be there long term. With Bedrock, our compensation model, how we get paid, is based on the long-term performance of the asset. So every time we look at an asset, we're thinking of these 3 things. Will it earn a competitive cash-on-cash return? Will it go up in value? And how much time will it take to manage? Our contract at Bedrock says if you don't get a 4% net cash-on-cash return, we will waive our fee. That is the fundamental promise of Bedrock. If we can't get to 4%, we will waive our fee. Other companies had to have a long-term vested interest in the success of the property, and they had to have business management to take care of the day-to-day headaches. This is the secret to buying a piece of investment real estate today. Okay, the old rule was the 1% rule. I actually we talk about internally in Bedrock what we call a gross rent multiplier, just because it's a little easier to round it out and get some math that makes sense. For example, if your rent is 200, I will buy almost anything under 150. Different markets are different. We're buying in 6 major US markets. We're buying in 9 states. We have 13 property managers working with us every day. I will consider something under 150 GRM. AKA, if it will rent for 200,000, times that by 150, I would like to be buying that property for less than $300,000 all day. The lower the GRM, the better. Let's look at some examples. We're buying actively in Oklahoma City. I just looked at every 3-bedroom, 2-bath house in Oklahoma City, renting for less than $4,000 a month. There's a lot of inventory in Oklahoma City. We like Oklahoma City. We vet it heavily. Here's what we typically see in Oklahoma City. 3-bedroom, 2-bath, $1,600 a month. 3-bedroom, 2-bath, $1,500 a month. 3-bedroom, 2-bath, $1,800 a month. 3-bedroom, 2-bath, $1,900 a month. You can see Oklahoma City, a 3-bedroom, 2-bath goes between $1,500 to $2,000 a month, kind of all day, every day. If we zoom in on a specific property, I picked this yesterday Out of the blue, I picked the first two properties. I know Oklahoma City, so let's just talk about Oklahoma City for a minute. This house in Oklahoma City, $1,600 a month. Zillow does not offer his estimate when it comes to houses that are renting. But if you go to realtor.com, you will see that house that is renting for $1,650, the realtor.com estimate says it's worth $250. So again, you take your $250, you divide it by your rent, GRM of $151. I would look at that house seriously, especially because it's a beautiful build. That's like a late 80s, 90s build, 3-bedroom, 2-bath, the same rent. If I times this by 2, I'm looking at California rent, right? $3,500 a month. That same $3,500 in California cost me $2.5 million to $3 million for double the rent. I would pay 10 times the price in California to get only double the rent. And that's because the GRMs in California are like 600 or 700. They're insane. The numbers are never going to make sense. It's never going to cash flow positive. There are markets in the country that cash flow. Go to Oklahoma City, Charlotte, North Carolina, Cala, Florida. Go to the markets where we're buying and you will see the numbers are fundamentally better. This house here, that house on realtor.com divided by $1,650 a month, $130. I think I messed that up. 215,000 divided by 1550, 138. Still lower than 150. As long as the house does not have major problems, I can make some money. If you look at San Mateo, California, where a lot of people on this call are from. If you look at Northern California, same study, 3-bedroom, 2-bath, 1.7, 1.8, 2 million. This picture I took in 2017 when we've launched Bedrock. Numbers are even worse now. Those assets should be renting for, 1.7 million, somewhere around $17,000 a month. Let's cut it in half, $9,000 a month. They're renting for $4. The assets are worth more now, renting for less in Utah, California. The real estate market is garbage, and it's hard to get a competitive cash-on-cash return. My job and Bedrock's job is to help you see through the window of other markets in the US that are competitive. If you buy a house in these markets, they will perform as advertised, and we do the day-to-day. So it's as passive as possible. You own it 100%. You're not in a syndication. You don't own fractional shares, fractional ownership. You own it 100%. You hire our company to deal with the day-to-day. We work for you. My team has helped people buy over 5,000 properties. We're the McDonald's of real estate. Okay, we do not buy anything except this. And I'll be candid, this is all I buy. This is all I will buy. If you come to me and say, buy me this duplex or fourplex, I'll say, sure, but I cannot guarantee the results. We buy the same thing over and over, and that's why we've been able to get the same taste in our burger. We buy 12 to 2,400 square feet, 1980s or newer, 3-bedroom, 2-bath, in entry middle-class neighborhoods, Class A, Class B, where you feel safe. We want the highest cross-section of renters to buyers. That's what Bedrock buys. That's what we'll continue to buy. Our team has helped buy over 5,000 of now. We are usually buying between $130,000 and $225,000. We're shooting for a 5.5% cash on cash. What we are buying. It takes a lot of work to buy good real estate. You got to find your markets, submarkets, all your lending. You've got to have brokers that you trust. You've got to have property managers you trust. There's a ton of work to buying good real estate. We've helped people buy over 5,000 homes. We launched our business management, dealing with the day-to-day 7 years ago, and we're managing hundreds of properties. Here are some pictures of properties Bedrock has helped people buy over the last 7 years since we launched. They all share some things in common. Usually they're brick build, 3-bedroom, 2-bath, 4-bedroom, 2-bath, between 12 to 2,400 square feet, 1980s or newer, after the lead ban. I know that one really well. That's Albin. I know that one really well. So we have just absolutely bought kind of the same things over and over and over 5,000 times. We specialize in one thing. Bedrock is two companies. One helps you buy it. One helps you deal with it. Okay? And that's the way I realized the industry needed to fundamentally change, is you had to have a company that helps you deal with it, whose compensation was directly tied to, is it working? Right? We offer an a la carte service. You can just use us to help you find, vet, and buy property, or you can use us to help you find, vet, and property, and then hire us to deal with the property on the day-to-day basis. If you hire us to deal with it, if we don't earn you 4% cash on cash, my team will do all the work and we will not get paid. We'll refund our fee. We vet every property as if we're going to have to deal with every property for the next 5 to 7 years. And if that property doesn't perform, we vet every property as if we have to do all the work for the next 5 to 7 years for free. That is the fundamental difference between Bedrock and everyone else. We will do all of the work, and if it does not perform as advertised, we will do the work for free. Finding the house, we'll talk about that at a different, today was more about inflation. We have to do a ton of work to find these houses. We look at about 200 houses per every one we put in front of a client. For every house that we put in front of a client, we usually put 7 to 15 in front of a client before we're able to make an offer and get it accepted. The client likes the house enough to make an offer. So we're usually putting about 1,000 houses through our hopper before we actually get one purchased. Multiply that by 5,000 houses over the last 20 years, and you can see it is a ton of work to help people buy houses. We have to have all of the qualified parties to be able to get this and get it smooth. We do that very well. We buy the same thing every single time. After closing, we hand the property off to a property manager in those markets. We have vetted those property managers. You can either work with them, or we can, once done, the day-to-day management of the contract comes in. We bill very directly. If you just want to pay $3,500 a year per property, or reduce our fee to $1,000 a year. If we don't achieve 4% cash on cash, we refund our fee. And you might say, well, Jeremy, how can you possibly run a business like that? Because we take the risk alongside you, we get a bit of the appreciation. Now, that sounds fair if I'm picking something that will appreciate. I'm willing to say, if it doesn't cash on cash work as advertised, we will do the work for free. And we will only make money when it appreciates. That is how certain I am it will cash on cash properly. I do not want to pay my people to work on your property for 5 to 7 years while not making a penny. That is how sure I am not buying garbage, because I'm only getting paid if it appreciates, which is the same way I would want to be dealing with a property if I was you on this call. I would want someone saying, hey, if it doesn't cash on cash right, I don't get paid. I don't get paid unless it appreciates. We vet every house as if we're going to pick up a business management contract. Whether we do or not, doesn't matter. But we vet every single house as if we are, because we assume we don't know who's going to want a business management contract. If you don't want us on for the appreciation, you can just pay our flat fee, $3,500 a year per house. It is an enormous amount of work setting up LLCs and banking and administrative and reporting and dealing with tenants and dealing with insurance and dealing with property managers and compliance. It is an enormous amount of work. That's what it costs to do the work. Let's look at a couple of markets where we're currently buying. We're buying in Ocala, Florida. We love that market. Feel free to take a screenshot. I'll send out this pitch deck so you can see what we like about each market. Here's a property we just bought in Ocala. We bought it for $248. Our client put down $71. We had them put in some money for reserves so we can operate the property, short-term reserves, long-term reserves. At the end of the day, this was 146 GRM. Ocala, Florida has been appreciating by 12 to 20% per year for the last 5 years. Cap rate 6.01%. We're buying in Memphis, Tennessee. We've been buying in Memphis since 2017. It's getting a little more expensive in Memphis. We may eventually get priced out of Memphis based on our box, right? There is a ton of good economic data coming out of Memphis. Here's a house we recently purchased in Memphis. $205,000, 137 GRM, renting for $1,500 a month. 205,000 divided by 1,500, 137 GRM, cap rate 6.3. Fantastic asset. I would buy 100,000 just like that. And the truth is, American Homes for Rent does that. BlackRock does that. They just buy hundreds of thousands of these properties at a time. The difference is between them and us, they keep the depreciation, they keep most of the upside, they pay a specific percent. Where Bedrock, you own it, you get all of the upside minus our fee. If it doesn't get to 4% cash on cash, we waive that. We're buying in Bentonville, Arkansas when we can find a deal. It's a smaller market. We have trouble finding deals there. Bentonville, bought it for $207, renting it for $1,400, 5.6 cap. We're buying great assets in these markets. Compare these to your local market. What would it cost to buy a 2023 build, 3-bedroom, 2-bath in Salt Lake City, Utah? 500 grand, 600 grand. What would I rent it for? 2,000, 3,000. The math is amazing because of the market where we're buying. I've got an echo from you, Imran, just so you know. Oklahoma City, We're buying very actively there, 136 GRM. We're finding this type of property all over the country. Memphis, Ocala, Arkansas, Oklahoma City. We love the markets we're buying in. We've bought over 5,000 properties over the years. We're freaking loving what we do. Next, we're going to do a question and answer where you guys can ask me any questions that you want. The last question is, how am I going to move forward? What do I do if I want to move forward? Figure out what your money's in: cash value insurance policy, home equity, stocks, IRA, 401k. The only thing that really changes any of that is IRA, 401k, because lending requirements are different in an IRA or 401k. So you have to have a little bit more money. Anything else, you can buy a good house for about $70,000 down. If you're going to do that, you have to have about 620 credit, and we'll help you through that whole process. So that's the basics. I think that real estate absolutely crushes gold when it comes to protecting against inflation. I think it should be part of everyone's portfolio. I think we're buying some amazing stuff and managing that amazing stuff, overseeing all the work. We're having a blast. Thank you for joining me. Feel free to ask any questions in the chat, and I'll stay on for a while and answer any questions. Otherwise, go out and get some real estate. Feel free to get it from whoever. If you want to get through me, we'll stand behind our work. Thank you so much for joining me today.
I wanted to say, again, express our gratitude for Jeremy being on today, giving us the insights. One thing I love about this every time I talk with the Bedrock, Jeremy, Anthony, his partner, is how willing they are to share some of their inside information on where to buy real estate, right? And they've got even more than that. They've got more, and they're willing to share with you where to get it, because real estate is always what? It's location, location, location. And I think the greatest thing about Bedrock and what they've done here is they've got math. Math doesn't lie. It's one of my favorite things. It's why I love what I do with IULs and everything else. But with the real estate, it's like, how do I find the math to make this profitable? And that's what you're seeing here with Bedrock, is the opportunity to jump in and find that win-win property where you can go in and, again, some properties you can go in, and if the numbers, hey, that looks like I could get a great deal. So again, I am always extremely grateful for when Bedrock gets on here and is willing to share their inside information, that inside secrets. If you have any questions, we can stay on for another couple of minutes. I'll give you another minute or two. Any questions you may have, you're more than welcome to type those in right there. Now, Jeremy, one question that I see that we have right there, you mentioned it as we end right there, your experience with buying over 5,000 properties. What does it typically take to get started? So if I just want to get started, what does it typically take to just get started?
Yeah, these days we're buying typically between 215,000 to 265,000. And so with an investment property, you really are looking at putting down between 20 to 25% so that all the math lines up the way you'd want it to. And so to get started these days, we really are seeing that you can get into your first piece of investment property with about 70 grand, right? Because we're not going to go out and buy something that's $50,000 cash. It's just a disaster idea. We're not willing to sign up and say, hey, if it doesn't get 4% cash on cash, we'll do it on a really, really, really low Class D, Class C neighborhood. We're only willing to make that sort of promise when the property's been vetted correctly. And in our market, we're wanting the highest cross-section of buyers and renters, because when you 5-7 years from now want to sell, we don't want the only person interested in buying this property to be a hedge fund that buys garbage properties. We want it to be able to go to an owner and get highest number of eyeballs on that property. And so, yeah, it takes about $70,000 to buy a property. That's the minimum kind of down payment to play in the, in the area we play in, which is buying something between 215 to 265, a good Class A, Class B asset, 3-bedroom, 2-bath, all the other things I said. That's a great question.
Awesome. If somebody puts in the 70,000 right there, paint that vision one more time for us. Year one, our goal and objective is to hit these kind of numbers, and then by year 5, hit something in this ballpark.
All right, I'm going to actually put up an annual review. We do 3 versions of this for every client every year on every property. Okay, this is a Memphis, Tennessee property, Rockshire Cove. And you can see here on this view, We're sending this out to every client every year. It's part of the LLC compliance package. We review every single dollar of rent of income that came in. We review every single expense that was paid. Now, some expenses are paid from property management. Some expenses are paid from the LLC proper. And so we're gathering data all year long to make sure we know exactly how much money came in. $21,000 came in rent. We had a mortgage on this property. $11,000 went out to mortgage. We had property management on this property. $1,800 came out property management. At the end of the day, this client netted $3,600 that year. Now, this client only invested $54,000, right? It was a leveraged asset. And so their cash on cash for the year was 6.7. Now, on top of that, they had principal pay down for year 4 of this asset, which was another, $2,000. On top of that, they had some appreciation. When we bought the property, it was worth 207 grand. Now it's worth 260, but on Redfin, Trulia, Zillow, all of them have it benchmarked at about 260. It's like $55,000 of appreciation over that 4-year hold. And so we're able to break that all down every single year for every single property that they hire us to do this for. And we send that out. So this property, hey, 6% cash on cash, 40% total ROI when you break in your principal pay down, your principal reduction, your appreciation, your depreciation. When you bake in all the different layers of the sandwich, the burger, 30, 40%. Now, if we had taken that straight as a cash asset, I pulled up another one of these just for this, right? That same exact asset, if the client hadn't put down 50K, if they'd put down 240, right? The purchase price was 230, but then they pay us, they pay closing, this, that, and the other, right? So that client put in 240. He owns at 100% cash. There is no gigantic mortgage payment at the bowl eating all the money, right? $19,000 in. They still paid property manager. They still paid us. They still paid some basic repairs. They net 12,000 off of an investment of 244,000. This client saw a 5.2% cash on cash return. Again, if we can't get you to 4%, we'll do the work for free. That's the Bedrock promise. That's the way our contracts are structured, right? But this property has only been in there for 2 years. We bought it for 233. It's now worth about 250. And so they do have some appreciation also coming in. It's still earlier in this process. What we're shooting is between 4 to 7% cash on cash, whether you buy it cash or leveraged. My one warning would be if it's leveraged and you have a tenant move out or there's some damage. Leveraged properties, the big dog at the bowl is always the mortgage. Leveraged properties, you can have much higher returns long term. 30% versus 7% leverage looks amazing, but leveraged properties are also just higher risk because there is a mortgage there. If you have a move out, it can have a 0 or slightly negative return. We have seen that every once in a while, but over time, people make more money than leveraged. And with inflation being a concern, I would say leveraged if you can afford it, if you can take that risk. If not, it's better than an annuity. It's better than a bond all day long because you can still earn 5, 6, 7% while the asset goes up in value.
Awesome. Well, thank you, Jeremy. I just love that. I love how it breaks down again, and like I said, the scientific process behind it, and like I said, systems. Save yourself time, energy, and money, and that's why we partner with them. That's why we refer people to them because of their core values of empowering their clients with information and knowledge to make the best financial decisions for them and their loved ones. Anything else, Jeremy?
Nope, that's it. I appreciate all your time. I appreciate you guys hosting us. And lovely talking to you as always, Imran. Thank everyone for being on the call. Hopefully this will be a good fit for some of you.
Thank you. Have a good weekend.
All right, bye-bye. I hope you enjoyed that webinar. We recorded that with Imran Andrew and Three Dimensional Wealth. But I just looked at it and I went and reviewed it and I just said, man, there's so much here that needs to be said. It took an hour to say it the first time. It took longer than that to edit. So I hope you enjoyed that. I hope you got some value out of that. And yeah, if you want any conversation around real estate, feel free to call us. Like, that's what Bedrock does. That's some of the reason for this channel, of course, is just to let people know, hey, there's products out there that do better for inflation. 30-year fixed mortgage is like a miracle. So if you want to have those conversations, just DM us. We'll start having those conversations. If you enjoyed this kind of deep dive, into a specific deep financial product. That's what this channel's about. I've started between 17 to 30 companies, depending on how you count. And I realized a couple years ago, I've had this incredible life of challenge and success. You know, rags to riches multiple times already, and back to rags. It's not all been success. It's not all been failure. It's been this incredible life I've been able to live. And I just decided, hey, I'm going to give something back. I'm going to start giving something back now. We're going to start making more relationships now. And I thought, hey, maybe YouTube's a place where we can start giving something back and start helping other entrepreneurs make some good decisions, help them learn from the mistakes I've made. If you enjoy the deep dive onto a financial topic, I think you're going to love Never Buy Rentals Here. The subtitle for that is the #1 key to a profitable rental. If you want to know more just about rentals, that's a great place to start. It's where we at Bedrock start. The highest level hopper to look at, is it even considered a deal or not? We build the box. I walk you through how to build a box, how to compare that box to different markets, how to compare at the highest level, hey, is this even a good market, or is the whole market structurally weak? If you like that, I think you'll love that one. I'm going to put that one here. Never Buy Rentals Again is going to be right here in the thumbtack. If you want more current events, I did an hour and 10-minute breakdown the other day when the day after Liberation Day for Trump's tariffs. We did a video called Trump's Tariffs Explained. That's the highest viewed video on the whole dang channel for some reason. But I walked through another one of the companies that I own, Crash Pads, which imports from China. I walked through everything on that video, how the imports affect our cost, our supply chains, our profitability, our employment, how I think they're going to affect repatriating jobs, how I think it's going to affect national security and foreign relations. I just try to take a look from my experience and my businesses that actually have kind of direct hairy impacts from tariffs and walk people through that, because I think tariffs are terribly misunderstood. And so I did an hour-and-a-half conversation, Trump's Tariffs Explained. You'd have to go to the channel and find that one. Just click on the main channel and look around. Trump's Tariffs Explained. I'm in like a blue shirt. If you want more kind of interpersonal stuff, just to get to know me a little better, feel free to watch the title on the video is I Didn't Know My Worth, It Cost Me. But the subtitle is I missed out on $250,000 twice in my 20s. That's actually a piece of how I started Bedrock, but it's just a lot of information with me trying to help people understand, like, hey, it's a journey. You know, it's not all success. There's a lot of bumps and bruises along the way. That video is wonderful, kind of interpersonal and entrepreneurial. I'm sorry I can't put them all on the thumbnail. The thumbnail is going to be Never Buy Rentals Here, because that's real estate specific. It's box specific. It's looking at what makes something profitable. If you just want to work with some professionals who know how to do that, feel free to DM us and we'll get in contact with you, go from there.